Hello viewers, we'll be going over WTI crude oil. In this video, we'll be going over the day-by-day probability model, the technical performance of each model, how we find the models, comparing the current trend with the trend in the past, and we'll go over the day-by-day forecast for WTI crude oil. So back to the technical analysis, today we're up 1.6% on the 1 hour chart. We were touching oversold, or I should say overbought RSI. We have now set divergence on the MACD, and we are now averaging around the 200 moving average on the 1 hour chart. As for the 4 hour chart, we have now approached to the positive MACD, and we have not reached overbought RSI yet. If we expand that further onto the daily chart, we have right now, we're still in divergence back in June 9th, and we are still approaching to the negative MACD. At the moment, we are encountering possible resistance around the 200-day moving average. We have not reached that in several days or even several months. And that 200-day moving average will act as our resistance, and that is around the price of $44.69. And as for support, if we do manage to head down lower, I do see the next possible support being around the price of $35.37. And if we do manage to fall down to that support level, that price movement to the downside is roughly around 11.4%, and to the upside to hit resistance, that price movement to the upside is roughly around 12.4%. So now let's head back to the day-by-day probability model, and these models are now available in the link below, so do check it out. So as we progress to the 7th day, we have a 33% chance for WTI crude oil to climb higher between 0 to 5%, and in the extreme case we have a 8% chance for WTI crude oil to climb between 5% to 11%, and to the downside we have a 33% chance for WTI crude oil to fall between 0 to negative 5%. And further extreme case to the downside, we have a 25% chance for WTI crude oil to fall between negative 5% to negative 11%. So now let's examine the day-by-day forecast for WTI crude oil. So as we progress to the 1 day out, that will be a Thursday, and 2 days out will be a Friday, and so on. So we have 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is the best match to the current trend. Right here we have our current trend, and overlapping it happens to be the best match. And right here on the chart we have our current trend, and below the trend that we found on the line graph, and this trend dates back to September 30th to November 11th, 2009. So let's begin comparing the both trends. So we start off at the middle Bollinger Band, proceeded to average above the middle Bollinger Band, and towards the very end we did revert back to the mean to the middle band. So now in the trend in question, we start off at the middle Bollinger Band, average above the middle Bollinger Band, and then finally towards the end we touch the middle band. So what we have here is 1, 2, 3 points. We also have 1, 2, 3 points. So there's reason to believe that the trends and patterns are somewhat the same. The outcome and forecast should be fairly the same. So the model that we just examined was back in September 30th to November 11th, 2009. Back then, WTI crude oil was down, say, 1.7%. And if we head back to the day-by-day probability model, that coincides with this standard deviation of WTI crude oil falling between, well, we have a 33% chance of falling between 0 to negative 5.3%. So now let's examine closer on the technical performance of each trend. So if we examine the current trend first, on the current trend, we're down 2.4% from monthly high, up 12% from monthly low, up 32 basis points from 10 simple moving average, up 1.5% from 20-day simple moving average. There's no 50-day simple moving average because we're only examining a 30-day trend. So now let's examine the trend in question that we found. So back then, the trend was down 1.7% from monthly high, up 12% from monthly low, and we have up 50 basis points from 10 simple moving average, and up 52 basis points from 20-day simple moving average. So among two trends, there are technical similarities. Only one thing note, back then it was up 52 basis points. Compare that to the current trend, which is up 1.5% from 20-day simple moving average. That is really the only major difference among two trends. And these models are now available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.